excited for this webinar on capital planning. As Alex said, today you'll hear from our Executive Director at the Public Finance Initiative, Lourdes, Germán, and Kyle Wedberg from the Government Finance Officers Association, or GFOA. For our agenda today, we'll start with a brief introduction to the Public Finance Initiative and some welcome remarks from Lourdes, do a quick poll, and then have a presentation by Kyle, and then follow up with Q&A. So if we want to advance to the PFI slide, the Public Finance Initiative is a nonprofit organization that works to embed values in public finance decision-making to create lasting change in the world. And we do this by providing education and technical assistance, and have worked with over 476 governments throughout 47 states in the last several years. And one of our major programs right now is the Rural and Small Cities program, which aims to shift patterns of disinvestment by building capacity to unlock public finance resources and integrate philanthropic investments. And we do this through two tracks to provide technical assistance and training to a wide variety of entities, states, public authorities, bond banks, local governments, and other stakeholders who receive assistance to develop and pitch a program-related investment to funders, and a 2-day workshop to build capacity to invest in their desired place-based outcomes. And with that, I'll share some resources that there's also in chat. If you'd like to learn more, please check out our website. And now I'm happy to turn it over to Lourdes for some welcome remarks.
Great. Thank you so much, Katie. And thank you to all of you who have joined us, and to Kyle from GFOA, who I know is going to present an incredible and thorough body of work on capital planning. And I'll tell you a little bit about our theory of change in this program and why we're so excited to have Kyle join us today. This is the question that keeps us up at night as we think about how to serve small and rural jurisdictions and other governments we work with, is what does it take to think differently about public finance? And in a way that centers place-based outcomes, but also shifts patterns of disinvestment and ensures that the resource base is flush for operating and capital priorities that we know are really significant. And if we go to the next slide, I want you to picture your community or a community that you've worked with and think, what might it take? What might it take to actually bring all the resources to bear that this community might need? And if we go to the next slide, you'll see a little bit of how we might answer that question for communities across America, across your jurisdiction, and in any state. Like you can see here pictured in just a fictional state. Some might be more dependent on their own taxes, and we know that tax bases are constrained, particularly own source revenues, including charges, fines, fees, but the money that you raise on your own. Some might be heavily dependent on grants from the federal government, state government, and even counties. Some might be really ambitious in drawing in funding from the CDFI sector, thinking about community investment and mission-based lenders in the way that they can fund a small business ecosystem and other projects. And regardless of what that dependency and the mix of the money, like a puzzle, looks like in any particular place, if we go to the next slide, you'll see a little bit of how we're approaching this work and suggesting, even if you have, let's say, a combination of these three sources, what if you could think more expansively, as you see on the next slide? What if you could think about integrating, if you're not already, municipal securities, program-related investments, philanthropic grants, and also philanthropy as a social investor? And on the slide that follows, you'll see a little bit about how this has anchored what we're doing in this program, where communities are facing disinvestment and can't fund critical needs because they're highly dependent on one or two or a few predominant sources of funding, but they're still facing volatility, whether that be through federal aid that's shifting or their own constraints. To change that doesn't just take raising money on your own. We don't think that's the end of the equation. We're thinking about the role of rural serving organizations in stepping up and playing a vital role to those jurisdictions. We're also thinking, as my colleague Katy mentioned, really creatively about how could philanthropy show up differently as a social investor and create pathways to the capital markets in particular, which is such a huge resource base, in ways that we could consider expansive from a public finance standpoint in growing that fiscal base sustainably and thoughtfully. And then finally, why we're so excited Kyle is here today is to think about the fact that it's not just dollars alone, but the practices that you have in tandem with money that you raise are really important, especially capital planning. When we think about capital absorption challenges, i.e. the ability to absorb money in a way that drives forward your priorities and sustain change. And that's why capital planning is one of the many strategies that we're really elevating as important in this program, that beyond the dollars really matters when we think about the outcomes we want to achieve in places across America, particularly those that feel most left behind. And with that, thank you for joining us today for the presentation. I'll turn it to my colleagues to begin the webinar.
Thank you, Lourdes. I'll flag before we turn it to Kyle that if you'd like to ask a question, please click the Q&A button in the Zoom toolbar and then ask your question in the text box and push send. We'll monitor these throughout Kyle's presentation and then ask as many questions as we can of both Lourdes and Kyle at the end of the webinar. And with that, we'll turn to Kyle. I'm very excited to introduce Kyle Wedberg, who is a public service leader whose work has bridged education, the arts, and government. He served as a senior finance and administrative executive roles in Chicago, Philadelphia, and New Orleans, including as CEO of the New Orleans Center for Creative Arts and chair of the New Orleans City Planning Commission. He currently serves as a senior manager with GFOA, a fellow at the National Academy of Public Administration, and is on the advisory committee for the Rural and Small Cities program at PFI. Welcome, Kyle. Thanks so much for joining us.
Thank you for having me. This is a fantastic opportunity, and I look very forward to learning a little bit more about the questions that are out there. I've been looking at the names and the locations that are coming in. We've got friends all the way from the California Finance Officers Association in British Columbia to Auburn, Maine. I present from the Third Coast down here in New Orleans, Louisiana, and I'm going to run through a healthy amount of content. At GFOA, I have the privilege of leading committees of national thinkers that do best practices. Lourdes serves as one of our advisors for the Committee for Economic Development and Capital Planning at GFOA. I also teach classes in this, and that's not a sales pitch. That's saying, for those of you that are interested, and there's resources out there, and my email is on the deck. I'm happy to follow back up with you. But talking about capital planning in asset management is more than a 30-minute conversation. So just a little bit about where I'm coming from as an organization. Finance Officers Association has been around for over a century. It comes from post-construction into the Woodrow Wilson professionalization of government, thinking about government finance as more than in eliminating the practice of patronage. And we've grown to have approximately 28,000 and growing members in the US and Canada. One of the places that we work on with governments is around this idea of capital planning. And so wanted to just baseline to get some shared understanding about what capital assets are and what infrastructure assets. Capital assets are a very large class, can include all sorts of pieces and parts of your government that are above a capitalization threshold. The infrastructure assets are the really big ones, and those that are horizontal, vertical infrastructure, subsurface infrastructure, often stationary in nature, but doesn't have to be. Your fire equipment, your ambulances, different pieces of apparatus on this, but just want to level set what we're talking about when I say capital asset and infrastructure asset. And the reason I do that is going to ask a couple of questions, and there's no right or wrong answers to this. You could be in multiple places as it relates to these poll questions, but I just want to see for our group of about 80 people that are on this, where you're at. So what's most likely for your government? That an asset fails in your jurisdiction, that you have a pending large grant that you think is going to come through, that you have an asset that you don't know what shape it's in, so you're going to do a condition assessment of that asset to see what shape it's in, to use data to make asset-based decisions, using that strategic data to think about your assets, or that weather causes a big problem for one of your assets. What's most likely for your jurisdiction, let's say in the next 12 months? And we'll give a little time for folks to answer. And I think multiple of these could be in play for you. And certainly for some of you, maybe some of this is rather regular actions, right? Using strategic data. I hope for many of you using strategic data is commonplace. I hope for many of you that you're doing regular condition assessment of your capital assets. Going to give it another couple minutes to just see where people are, or another couple seconds to see where people are at. Interestingly, what's coming up for many of you, about a third to 40% is what you think is most likely. And I'm going to go ahead and end the poll because we got a couple other questions I wanted to see. For many of you, for more of you than are going to use data in the next, and not will for what's most likely, more of you have an asset failure in your jurisdiction as more likely than using data, which is fascinating. All right, so let's flip this a little bit. Same answers, but what keeps you up at night? What is it that you lose sleep over relative to your assets? Is it the failure? Is it getting that data? Is it doing a condition assessment? What is it that you're most worried about? Alex, I don't know if do we have the next poll question up? If not, I don't want to spend too much time on the logistics. So I'm going to jump into our third question and just have you answer this for yourself. If you had the power, what would you activate? Would you have a capital asset last another year, that you would get a large scale grant, that the asset assessment that you did would return a good grade, that the data would be available to make better decisions, that the weather would pass over you for one more year and not impact a key asset, or that you had just a little more bandwidth, just one more person to work on these issues. And I'm guessing people are putting this in the chat, which is fantastic.
And this came through, Kyle, with one poll. So our results from this, for those that were able to answer, is about a third thought a capital asset that falls in your jurisdiction would be activated. And the other real leading question is the strategic data that is available to make asset decisions.
Great, great. Thank you, Katy. For each of you, if you had the power to activate something, what would you activate? And these are all possibilities. And then the final question I had for you, just to get kind of your thinking going, is are you seeing deficiency? And this I'd just like you to drop into the chat. Would love for you to see deficiencies in capital planning you'd like to share with us, or creative solutions. Are you seeing deficiencies in capital planning, or are you seeing creative solutions? So anything you'd like to share, please just drop that in the chat. So that's all great and really do appreciate it. So the why for capital and strategic planning. So this is one of my all-time favorite quotes. It's from Daniel Burnham. And Burnham is the person who is engaged to do the master plan for the city of Chicago after the Great Chicago Fire. So the city has been through some extreme devastation, and he has the opportunity to set the tone and build some thinking for what is now the Loop and some of the most important parts of that city, and some of the iconic parts of urban planning in the country. And he says, make no small plans. They do not have magic to stir people's bloods. Aim high in hope and work, and build something that long after we are gone will be a living thing asserting itself with ever-growing insistency. So no one writes like this anymore. It's gorgeous prose. But the point is, you're building something that's going to last longer than you're in the seat you're in. You're building something that should have legacy and a plan that should be able to have people investing in it versus restarting in tabula rasa every year with something new and something that comes from zero every time. Theory of governance, I think it's a really challenging time to be sitting in the seats that you all are sitting in government, to be thinking about how to do the work and tell the story of why government is really important. 40 plus days after the federal government being on lockout, I think reinvesting in and believing in the power of public service is really, really vital. And so why do we do what we do? Richard and Peggy Musgrave write one of the most important, one of the seminal works in public finance. It's called Public Finance in Theory and Practice. And they argue that this is the work of public finance is the work of democracy, that for things to work, they have to be resourced. If you don't have money behind an idea, that's called a wish. You have to have money to resource those things to become ideas and be brought to fruition. And then John Rawls, for those of you that took freshman philosophy and had some study of the works of late 20th century philosophy, Rawls talks a lot in conversation with the theory of Musgrave and brings about two things. One, this generational work you're doing for government just does not require your generation to gather up resources to hand to the next generation, but rather you're trying to realize just institution and equal liberties. You're trying to deliver something that not just represents a functional government, but a fair and flourishing government. And in doing this, you're engaged in the exchange. And the exchange is that place where you are providing the pure public good where the market breaks down. People often say they want government to operate as a business, and in all actuality, you're providing that which the market doesn't. And so in some cases, it requires a little bit more, a little bit extra, and some subsidy. So you're working to make all of the needs of government come together. And in government, we need to shift our thinking. Our reality is shift. The largest investments in public infrastructure in the last century happened early on with the WPA, and in this century have probably already happened for us with the IIJA, the IRA, ARPA dollars. So we need to shift our thinking. And one of the things that governments are good at is getting really excited about the new and not taking care of the existing. The most expensive addiction in all of government is the cutting of ribbons, right? My dear colleague in DC calls it running with scissors. So we have to privilege our existing infrastructure. We have to think about that which we already own and taking care of that. And we have to incorporate that into capital planning. The other thing we need to do is we spend a lot of time as finance officers thinking about reporting. And so we do straight line depreciation and what was the cost of something when we put it into practice versus thinking about what it's going to cost to replace it if it were to fail. So we need to shift how we think in that way. And then we need to get people out of their silos. The engineers talk to the engineers, the electeds talk to the electeds, and the finance department manages the spreadsheet between all of that. We need to get out and think of the synthesizing and interpreting of this across the government to make it work better. And the reasons for this is that our infrastructure nationally is average at best. Every 4 years, the ASCE, American Society of Civil Engineers, comes out with a report that says how we're doing as a country relative to infrastructure. Your states each have a report card that comes out on a rolling basis. Louisiana, where I live, just came out, and we are a C- this year. But that C overall means we've got almost $4 trillion that needs to be invested to get our assets up into an A grade. And that's grown by $1.4 trillion over the past 4 years. So, do you have a CIP? Let's just talk for a second. And each of these slides is built in what we call our best practices. There are best practices for many different areas of finance for the CEDCP, the Community Economic Development Capital Planning Committee. I've put links into the best practices. They're also available on the GFOA website. They're available to anyone. So I encourage you to use them. Great third-party validation of this work. We encourage people to think about a capital improvement plan to be 5 years. The project scoping in a CIP should think about what the project is going to cost, inflationary pressures that may cause projects that are in the out years to grow better. There's a great book by Fleischberg and Gardner called How to Get Big Things Done that talk about some of the challenges in costing. You want that first year of your CIP to be the projects that you're going to try to implement this year in the capital budget, operating in parallel with your operating budget. You want year 2 projects ready to go and have some scope on and some political buy-in on in case you have projects that can't move or less from a timing perspective or some scoping perspective, can't get all of year 1 going. You want projects that are shovel ready to go so that you don't lose momentum. You need to set multi-year funding, and I'm going to talk about a long-term financial plan in a second. And you want to set all of these because I talk about this as the box, right? You want to build a box with your design principles and with the projects that you're going to try to take on in year 1. Because those projects in the box don't just tell you what you're going to do, because that's what lives inside the box, but it tells you what you're not going to do, which lives outside the box. Great ideas, new projects come in, you can have a way to respectfully stay in a political and administrative manner. We have our project set up. If you want to put something into the box, something has to come out of the box. This is what we have built that we have capacity to do, to deliver, and to afford. Anything new requires us to stop doing something, because I think too there's an expectation that we have things that we can take on from a operational and economic standpoint. The role of finance and asset management, I'm not going to read through these, but I think the one that I want to hit is the one at the top. Having some policies around this, what you're going to positively prejudice existing assets, how you're going to do processes for managing your assets, that you're going to think about that what you already own, that you're going to have some way to level set this for your government relative to data, level of service that you're going to provide. I think oftentimes there's a misalignment around what departments are trying to do and what the expectation of the government is overall in terms of level of service. So departments may be asking for more resources than in all actuality is needed, or may not have enough resources to deliver the level of service that everyone is expecting. So if you've not done this in the past, if you are new to capital improvement planning and asset management, the great place to start is an asset register. So the basic three questions: what do you own? Where is it located? And what condition is it in? Right? So getting those three set, knowing what you own, knowing where it's located, and knowing what condition it's in, what shape it's in, is actually a lot of work if you don't have it, and very important. There's also some additional questions here as you get more advanced in that, understanding what it's going to cost to replace it. So doing some assessments, some bid projection around cost to replace, thinking about maintenance history, making sure you're inside a warranty and useful life investments, and then thinking about the data. Who's responsible for what data and where is that data tracked, so you can hold all this together. So that's a good place to start. Another one that I don't want you to lose is criticality, right? We have communities all the time that have something fail, and the worst time to try to replace something is after it has failed, because you end up replacing exactly what was there. It doesn't give you the opportunity to do anything relative to evolving it for resiliency, level of service, desire. You can't bid this out in the same way that you could if you were doing this out in front of reconditioning or replacing an asset. And so you end up having the highest possible cost, returning exactly the same asset. And the project on the right functioned the way it was supposed to. This is the Oroville Dam in California. This is the spillway on the Oroville Dam. The difference being that the Oroville spillway had not been reconsidered as the use of land around the spillway had changed. So they came back and reconditioned it to have different functionality because it was unpopulated and agricultural when they put the spillway in, and 150,000 people got displaced when it did actually overflow downriver. Planning for those critical assets, don't bury your lead. If there is something that really can't fail, there's nothing wrong with investing a little more time, energy, effort, and resource into that which can't fail versus evenly treating all your existing assets. So thinking about what the loss would do, making sure you do condition assessments on your most critical assets, thinking about what investments are needed across time and making sure those are in your CIP. And then what is the plan to make sure that this asset continues? And if it's nearing the end of useful life, what's the plan for replacement versus coming up on failure? All right, long-term financial plans. I'm just going to make a quick plug for this, going back to our earlier conversation about the need for resources to make things function. The long-term financial plan is a 5 to 10 year document that has you looking at the resources that will be coming into your government and your underlying assumptions, your anticipations of the resources, what you know that you're going to have to do in terms of expenses, and what you anticipate in terms of revenues, to give you a better understanding about what resources you have available to work on the long term. GFOA has a best practice on long-term financial planning. I'm not going to read this to you, but just thinking about all of those factors that are driving your revenues and expenses. The benefits are here. It helps you think big picture, diagnose potential risks and causes of potential fiscal distress. It allows you for preemptive action, seeing where you may have to do, because in a lot of our states, we now have to go to the voters if we want to do millage increase or capital referendums. defining parameters for decision making, and communicating, having some conversation, having a point where no one is surprised, where we can see our challenges out in front of us. I put an example in the deck of just a long-term plan for this is from a utilities government in Minnesota. And for smaller communities, what I often hear is, yeah, but we don't have the capacity to do this. This is big government. I'm looking at a bunch of commas and a bunch of zeros. We don't have the capacity to do that. So found a really good example of a smaller government that's done this. It's a school district up on the Canadian border in northern New York. It's called the Salmon River Central School District. And I put a copy of a link to their long-term financial plan. They do a really nice job of outlining the assumptions, the expenses, the revenues, and they do a gap analysis to walk through what they will be getting and what they won't. Just a couple of examples of what's there for the state of New York. In addition to a per pupil allotment, they do a capital allotment for students as they sit in seats to help districts offset the costs of capital or debt and bond financing. But what happens is, as you have students, the number of students declines, your aid for that per student allotment for debt also declines. And so what you'll see is on their long-term financial plan, they're going to have a declining amount of revenue. So it may be right to right size earlier and maybe bank some of that, especially if you're doing debt across that, to capture some revenues to be able to pay for the out years of the debt. With their long-term financial plan, they give very, very, I think, basic but solid revenue projections and expense projections. And so if you're presenting this to your elected officials, you can show what is happening with revenues. Our revenues are going down and flattening. What are happening with our expenses? Our expenses are still going up. So what happens? We don't have enough money in 3 to 5 years to do operating and capital what we need to do. So we need to make some decisions. Is that going to happen on the expense side, the revenue side, or somewhere else? So it lets you tell a different version of the story than standing on top of the problems in the year you're in. And if you're thinking about capital planning, these are really expensive and long-term debts. So the long-term financial plan can help with your operating, but what you're really doing is building the scenario and the storytelling to be able to do debt financing or to be able to, if you like to pay for things, because no one says you have to do these out of bonds and debt. If you like to pay for them out of your operating budget and pay for them as you go, right, out of general operating, then you're going to have to save for a number of years to do some of your bigger expenditures. And if you are saving that money in some sort of reserve, you want to be able to articulate, remember, in our long-term financial plan, we needed to do 10 years of savings to achieve X dollars to do Y project. It helps you tell all of those stories. But the asset challenge is more than just bottom line. All right. We've talked a little bit about some of the tools you can use, but going into the future, and in fact, some of the case studies we're going to look at very quickly, the challenge is more than just affordability. It's actually a changing environment. This, if you want to look at the story, this tree's name was Stumpy, and it is one of the cherry blossoms that was planted around the basin in Washington, D.C., between the Washington and Jefferson Memorial. Because of saltwater intrusion into the bay, and then that salt water running over the wall. There's been a capital project to fix this wall, but it killed a number of the cherry blossoms, Stumpy being one of them. And so as your environment is changing, you're going to have to think about how to adapt your infrastructure to take care of some of the changes that are happening. Again, going back to California, not unlike the Oroville Dam, a brilliant woman by the name of Hong Lin, who is in charge of water for the state of California, gave this example that in 1973 in Paris, California, certain assets were built to do certain things in certain ways, and that utilization around them has changed. So you have to go back and revisit the existing asset. In 1973, the area around the Paris Dam was just farmland. And now it's a city. And so you have to think about the loss of life, the value of real estate, the personal insurance and wealth holdings of that community. The dam has to perform differently than it would have in 1973 because the conditions around it are different. So where ultimately would we like to get for your government? And as you're thinking about capital planning, where would you like to get? For most of us, we grew up in, or at least I grew up in, a government which did a very budget-driven framework. There were decision makers who said, this is the budget you get. And then we as department chairs or as the city administrator or as the finance director decided what programs we could actually fund. And the budget drove the programs, and the programs then said, this is the service level we're able to provide with the programs we've got, with the resources we've got. In all actuality, you want to flip that. You want to think about the level of service you're desirous of providing, because then you fund exactly the programs that provide that level of service. And the budget that you have in the long-term financial plan you build is to maintain a level of service. So whether that be fire, water, schools, or roads, you're deciding on the level of service, because then that informs the rest of your program and what resources you need to do that work. This is much easier said than done, but that level of service, I think, is a tricky thing that we often don't have enough discussion about. And I will say that from a governmental standpoint, oftentimes a department, let's think about police or fire, will argue for a level of service that may be well in excess of or beyond what maybe the electeds or you as an administrator would choose to set. And so having some community buy-in and having a shared understanding about the level of service you're trying to provide can really inform how and what you're funding and the level of resources you need to garner to do that. All right, so a couple of small government examples that I just really like because they're very creative, right? In each case, you're looking at a capital project that would have been close to the annualized budget. Well, in one case, well beyond the annualized budget of the community as a whole, right? So this first one is from Damascotta, Maine. This is a mid-coast city, about hour and a half up coast from Portland. And they had a chronic flooding problem, as you'll see in the bottom picture, in a large parking lot, which faces the Damascotta River, which runs out into the Atlantic Ocean, Bay of Maine out in the ocean. And the parking lot is multiple things as once. As in many of your towns, you don't have the luxury of having assets that are just one thing. So on the far sides towards the water is the public boat launch. There is a park that is just off picture, and then the main parking lot for the commerce of Main Street, Damascotta. So this is recreational and a commerce center, but there is a dynamic tension because there's also the rest of the city that needs resources to take care of capital projects in other places. So the project ended up being about a $4 million project, and it came from a number of places. They got some grants through the state for different streams. They used some operating funds, some town funds to fund some of the early on design and engineering work. They actually solicited some donations, and the town manager and some of the links that are there that you're welcome to follow up on. The town manager says you have to be very careful because you're already taxing businesses and citizens, so you don't want to be perceived as the city as going or as the town and going and asking for more. But they had some philanthropy, and they have the wonderful benefit of having some summer residents who were able to step up and fund some pieces of this. And then for everything else they couldn't afford, they did a bond to stretch that debt because this is a generational asset. And so people are going to use it across time. And so if you have a project that is going to be used across time, there is logic to having people across that same period of time paying for that through their taxes because they're enjoying the benefit of it. So the bonds all made sense, and they were able to raise the parking lot. They put a water retainage tank under it so they could do release of water across time. And one of the other things they did is there had been talk about doing fixed barriers. And the fixed barriers were desired by many of the commerce aspects of the downtown, the businesses and the people that were parking there. But for the citizens, they did not want to lose access to the fishing pier, the boat launch, and the park. And so the decision was made to use movable barriers. As there are challenges, they will fix barriers that will give the benefit, but they won't be permanent so that there can also be a permeability to allow for that recreation. So the mixed funding was needed to make the project work. The desires of all participants were found, and the ability to be creative in terms of the solution allowed for this to work for work for most of the stakeholders, but allowed for more resources to be garnered than would have otherwise been able to be availed through any of those single channels. A similar project jumped one too many. In Brandon, Vermont, you'll see in the bottom right, Brandon, Vermont had some flooding issues. They had a lack of ability to move water in and around, and the town, had been stuck for some time in thinking about how to do this because of a lack of resources from the local taxes and a cap on how much they would be able to go out and get on the market through bonds because of the rather limited resources of the annual budget of the city. And so what they did is they identified a place that would be highest impact, but it also happened to be in cooperation with a state highway. And when they started to look at the state highway, which was US Route 7, they had conversations with the state about the emergency funds that were distributed, the cost of these multiple flooding events, and they were able to then get the state to chip in and do a bunch of solutions on the subsurface infrastructure and do some solution sets on landscaping, sidewalks, all sorts of things that were benefits to the town for this one box culvert. And the box culvert has been successful in mitigating challenges going forward and in the future. In both cases, some creative thinking and some work to make a project that was successful for multiple stakeholders allowed towns to think about how to add fiscal capacity. But in both cases, this was the focus of a lot of work, not just from a dollar standpoint, but from a human capital standpoint, to make these projects go and manage them. There were resources for other capital projects, but in all actuality, a lot of the focus of the town leadership went into these projects for a time, but their success will be generational and long serve. So, challenges for some smaller communities, this is real. The availability of funds, the bonding capacity, the ability to bond, and Lourdes, who leads this work and does an incredible job of that, can walk through any number of scenarios where, as a smaller community, you don't have the same access to markets because you don't have the same access to the scale of bonds that cause the market to turn, or the capital needed to have the FAMA bond council that larger governments do. The staff, I have watched some extraordinary public servants as clerks and small town managers, but these kinds of projects take a huge lift and a large amount of your capacity. Construction availability and timing. There are towns, and we use two examples from the Northeast, but if you think about Colorado, Alaska, Saskatchewan, British Columbia, some of the towns I saw in the participant log and in the chat, you have very narrow construction seasons and limited capacity in terms of, even if you are going to farm this out to companies, those companies are also doing private sector work. So getting that availability and timing lined up so that the 120 to 150 days of construction season that you may have as optimal, you can get someone dropped into that window to do this work when you have the available funding. And then the expected level of service. What is your community demanding, and what do you need to provide to make sure that your community has, and that you have an agreement about they're paying for and expecting services at a certain level? Because at the end of the day, all of this capital work, all of these infrastructure projects are simply a mechanism to deliver services, either from the government or between citizens or from the private sector to the other two entities, and in the same recursive nature for the government to them. So what's that level of service? And there's a best practice that you can look at, but as you're thinking about funding and level of service, don't just think about putting the project in place. Think about operating it, thinking about the life cycle of maintaining this thing that you're buying. Are you doing it in a manner that makes sense? So from the Damerscott example, those collapsible and removable storage of, placement of the temporary flood walls, ability to maintain that flood wall. So, and the tank below and operating the tank and all of the things that go with it. So making sure you're thinking about the funding that's going to be required for this. Very quickly run through these last couple slides. But for any government, as you're thinking about your asset management, you can look at national standards, but as I always say, Home Depot sells the same door in Alaska and Arizona, and it performs wildly differently in the two. So having some data and having some thinking about your government and how assets perform in your government is really important. What you're trying to find is that sweet spot on the S curve so that you are having your dollars go farthest, that you're making investments to keep things into the good, satisfactory, and fair, and you're not letting assets deteriorate to a place where it costs more to return them to a higher level of service or even replace them. Don't do deferred maintenance. That's a classic failure of government to not do what we need to do when it needs to be done. And that creates asset deficits, right? And so the lack of investment, you can actually be creating a generational deficit. If you are not on that S curve and doing investments in a timely manner, you're going to have assets that continue to move into the more expensive category. And that asset deficit is something that you will transfer to whoever takes your seat next or to the generations that follow. And so this is actually important generational work. So to inform your CIP, I would encourage you, if you are just starting out on this asset journey, to think about doing a really good asset register. What do you own? Where is it located? What condition is it in? And then if you're willing to add others, what year was it bought or built? And are you planning on replacing it? Is this one of your most needed pieces of infrastructure, or does it hit that level of criticality and do you need to pay more attention to it? These best practices are all done by committees. Lourdes, as I said, is an advisor on one of ours for the Community Economic Development and Capital Planning Committee. There's also multiple best practices, and you are welcome to avail yourself of any of them. I gave my name and email address. You are welcome to use that. I know we wanted to leave 10 to 15 minutes for questions here at the end, so I've kind of run through this information, but it's all there available for you in the deck. The recording is there, and if you have other questions or follow up, I'm happy to do that at a later time. So with that, I'm gonna stop sharing and open this up for the questions.
Wonderful. Thank you so much, Kyle, for that really insightful presentation. I learned a lot about how to develop capital improvement plans that are accessible, the creative solutions to flooding and to building culverts, and the challenges small communities face, and some best practices. And a lot of what you said echoes what we've learned from partners across the country as part of the Rural and Small Cities program. So appreciate you sharing your expertise with us. As we've said, if you'd like to ask a question, please click the Q&A button in the Zoom toolbar and type your question in and then hit send, and we'll monitor those as we get going. We're really excited to hold some time for your questions. I think to get us started, Kyle, you started in your wrap up, but I think to reiterate for small municipalities and rural areas with limited bandwidth, there's so much great information. What can folks walk away with today? Where should they get started?
Yeah, so I think doing an asset register. So I think the place where most governments are, I don't want to say failing, but struggling, is having a sense of their asset deficit. You know, the operating budget is one that lives, you know, we know if we're going to make payroll, we know if we can afford our bills. But with an asset and with that idea of even deferred maintenance, I'll just do it next year. You don't see immediately the deficit that you're creating by consuming, because that's what you're doing every day by adding miles to your fleet vehicle or driving across the road. You're creating an asset deficit. And if you don't go in and do a condition assessment, you don't have any idea about what that deficit really is. So it becomes like a family secret that everyone knows is there, but no one talks about, right? And then it isn't until failure that someone is left to deal with that. And you don't want to live hoping that's not you. 40% of our people said it's, or 30% said it's most likely. A bunch of people said that they feared it. And so, you know, I think just living in a manner that you don't hope something doesn't happen isn't management. And
Right.
so getting a sense of that deficit so that you can start to address it. Because I think if you're going to ask your ratepayers, your citizens, your taxpayers to spend a little more, they want to know what they're getting in return. And when you build new and shiny, they can see it. When you
Hmm.
replace pipes, they can't as easily. So you have to walk them into, and this is a multi-year process of helping them understand what the investment is doing, why it's needed. And, you know, I always, in that, inside of that generational work, I think a thing that resonates is the decisions you're making now about this infrastructure are going to dictate whether your children or grandchildren want to live in this community. And that's real. And I don't say it as a threat, I say it because it's true. If
Right.
you don't deal with these things in a manner that is reasonable and that is sustainable, then you don't get to live around with your grandkids. That's real. That's real, real. And so I think There's a responsibility that is present in this to make it sustainable, and that's one of the reasons the RALs resonate so deeply with me is we're not actually trying to hand a bag of money to the next generation. What we're trying to do is hand a functional city that is working for all of its residents and citizens.
Yeah. And just a quick follow-up, thank you for that. On the asset registers, are there templates that could be shared or ideas of where to go there?
Yeah, so lots of places do this differently. In many cases, I would encourage you to not begin by starting an asset register, but to begin by asking your departments. Because in all actuality, your police department knows what cars they own. Your roads department is keeping track of what they're doing for their horizontal infrastructure. And so, in the case of Washington, D.C., when they went to do this asset register, what they found is that there were 12 different systems across all of their departments that were tracking some piece of this information. And what they ended up doing is just doing a data warehouse pull that all the information existed, it just lived in the silo. And so they just went and visited the silos. So I think before you start something, go and ask. And then that asset register, you need to be thoughtful about it. So this isn't an inventory list, right? You don't want every chair and every table. You want to have, there is some capitalization threshold that your government uses. So you only want those things over a certain value. But you want to know what is out there. And so if you have nothing, Excel is always a great place to start. You don't have to go buy a fancy system. Just figuring out what you own, where is it located, what condition is it in, and then starting to add those other components is worthwhile. So I've seen them on whiteboards. I've seen them in computers on Excel. I've seen them in paper lists. And some of them are much more efficient, but just starting is the important point. And I would be remiss to say you're all somewhere on this journey. This is not, no one is winning this and no one is losing this. My dear friend Brian Dazzler used to say, best day to plant the tree was 20 years ago, right? If you need a tree, there's no substitute for a tree. But the second best day to plant the tree is one needs a tree 20 years from now. You're going to be the one that planted it for him. So doing this work today just means that you're solving something that you wish someone had solved for you, and that'll be handed to whoever sits in the seat next, and will make all of your communal work with other people that are invested in and working on the town and the work of the community easier tomorrow than it was yesterday.
Sure. Yeah, thank you. You're such a wealth of knowledge. Lourdes, I have a question to direct towards you from the audience around the examples that we've heard today and others. Towns often have access to leveraging external grants to help them pay for these projects. And so the question is around what are some important steps that small towns can take in moving a capital project from an idea to being ready to secure funding?
Sure. And particularly if you're seeking to prioritize grant funding for a multi-year capital project, you want to make sure that that grant funding is going to support at least the right stages of the project. Because if you think about, is a project in planning phase? Has it been placed in service? Is it an asset that's existing? Do you need to acquire land? Grant funds often are a one-time gift or contribution unless you have a multi-year relationship with the funder. Capital assets that Kyle's been talking about and so artfully described, these are multi-year commitments. They have a long duration. And one of the biggest risks that you can do if you are going to bring in grant funding and commit to that being a key way that you seed this project is to think, well, what else is going to be there to really sustain the useful life? Because otherwise you might be setting up a project to have a really strong start, but you want to think like, will it be able to continue? Does it have also incidental operating expenses? And you want to go to that funder if that's going to be your primary source as a philanthropist and be honest about that. And also their questions might be, well, if we certainly are your partner in this vision for this getting off the ground, how else are you going to sustain the other pieces so that this project comes to fruition? And that's where a blended capital stack might be important to start mapping out and saying, what are the other levers that we can pull? What are the other tools in the tool chest? So that when that project is hopefully awarded that amount, you can successfully have not just planned for its beginning, but also for the future.
Katy, can I jump in on
I
that?
was going to say, Kyle, I saw a lot of head nodding heads there.
So,
Yeah.
Lourdes, that's spot on. And for a lot of grants, they don't want to be the only thing funding the project. They want
Right.
matching funds. And so that was what was really elegant with the two small government examples I used in Brandon, Vermont and Damascotta, Maine, is that they had been doing the work to a place where when they got the grant said we need a 10 or a 20% match. They had already figured out
Right.
how the first half of the funds were coming. I watch too many governments do it in the opposite way. They
Mm,
have a department that goes out and secures a grant that requires a 40% match, and they bring it in like they've found something, when all actuality, all they have found is a 40% deficit, right, for that project. And I talked earlier about having the box. The reason you have a CIP is if you do have a department that comes in with one of those grants that needs a match, is it something you were planning on doing? Because if it's not something you were planning on doing, I give you full permission to do less better and say no to that. Because if it's not solving an issue that you have gone through a regimented process and an articulated process to say, these are the projects we want to do, then that new project isn't actually new money. It's actually removing a project that you had, for whatever reason, come to a place was demonstrated need and demonstrated level of service and demonstrated priority. So be willing to say no to those grant dollars, and because sometimes they complicate things more than they solve.
yeah. And I think Kyle brings up a great point. Know your funder. Know what strings are going to come with the money. What is going to be the reporting obligation? Can you meet that? And if not, are there other sources of capital that will not require of you to make those commitments, which are very real and particularly can come with philanthropic grant reporting that often if you say, well, what if we funded this pre-development piece with our own source revenues or with a one-time contribution that's a little bit different from a different partner and save the philanthropic dollars maybe for a different kind of expense that wouldn't require that reporting level of the capital asset.
Thank you. I think we have time for one more quick question and answer, which is around, is there a way to know if a local government is over-investing in asset replacement at the expense of repair and maintenance?
There's some anecdotal ways that happens. You have failure. You have roads or a sewer treatment center that is not performing the way that again that level of service that you would want. So you're having boil waters. You're having so. I think looking at some of those failure points is an important one to see about where the ratio of investing is. And then the other thing, and this comes from the finance side, is for many governments at the state level or localized into your policies, there's a debt ratio that you can't go beyond. So for the combined taxation of your utility district, your city, and your schools, or for your individual government, if you do a lot of borrowing, there's a cap where it doesn't make sense to continue. Don't behave like our federal government, right? Be sensible about these things at the local level, because you can't run deficits the way that we watch our federal do. In behaving in the manner that is responsible and sustainable, there's only so much debt, especially for a smaller community, you're going to be able to take out. So thinking about this is why the long-term financial plan and a multi-year CIP is good, because you can't just sit around and think, well, we'll just throw it in the Amazon cart, pay for it, and figure it out later. There's a finite amount. So I think finding the balance, Katie, is not just about, well, are we doing too much of this or not enough of this? It's what can we afford? What level at which can we afford? Are there things we need to stop doing if we start doing something else? So it's more about finding a balance between all of those things.
Thank you. That's a helpful takeaway. Well, we'll wrap up now by saying thank you very much to Kyle and Lourdes for joining us today and to all of you for taking the time. We hope that you found this helpful, and we've added a feedback poll in Zoom. If you would answer it, it'll help us modify these webinars going forward, and we appreciate your response. We'll send out the recording and the resources and a mailing list sign up. You can find more information on our website on the Rural and Small Cities program. And with that, I'll say thank you all very much again, and I hope you have a great afternoon. Thanks.
Thanks, Katie. Thanks, Lourdes.
Thank you.